Imagine doing exactly what the financial industry tells you to do. You save a little from every paycheck. You drop it into a safe index fund. You wait, and you wait. And according to the math, right around the time you blow out the candles on your 85th birthday, you finally have enough passive income to replace your salary. That is the uncomfortable truth nobody wants to say out loud. The traditional path to financial freedom does not just move slowly, it actively robs you of your youth. If you want to replace your income and live entirely off dividends, the standard advice is a mathematical trap. But there is a backdoor, a specific framework that can cut decades off that timeline, shrinking a 68-year crawl into a sprint of less than 15 years. Today, we are going to unpack exactly how that works. Let us start with a number. According to data from the United States Bureau of Labor Statistics, the average American spends roughly $67,000 a year. But to keep things realistic, let us aim for a baseline of comfort. $40,000 a year in passive income, about $3,300 a month, enough to cover rent, groceries, utilities, and let you breathe. The psychology of wealth tells us that having this baseline changes how you interact with the world. You stop making decisions out of fear. But if you try to get that $40,000 from a standard S&P 500 index fund, or by buying shares in a massive tech company like Apple, you hit a terrifying wall. Apple pays a dividend yield of less than 1%. To get $40,000 a year from a yield that small, you would need over $6 million invested. Even a broader index fund, with a yield around 1.5%, requires millions. The harsh truth is that if we look at the actual financial data across the United States, the average net worth for someone under 35 is around $76,000. If you wait until you are in your mid-40s, it climbs to maybe $800,000. You cannot index fund your way to a multi-million-dollar dividend portfolio before your knees start giving out. The math simply does not care about your dreams. So how do everyday people actually do this? You have to change the mechanics of your wealth. Let us look at a real scenario. We will call him John. John is a regular guy who decided he was done trading time for dollars. He realized he did not need millions of dollars. He just needed a higher yield and a faster compounding engine. Yield is simply the percentage of cash an investment pays you every year based on its price. Higher yield means you need less money invested to hit your target. But John also recognized a psychological pattern. Most people spend their dividends. The secret sauce to accelerating this entire process is called the dividend snowball, officially known as a dividend reinvestment plan. When you get paid, you do not buy a coffee or a new pair of shoes. You use that cash to automatically buy more shares. Those new shares then pay their own dividends. It is a compounding machine that requires zero extra effort. By doing this with just $10 a day, the price of a decent lunch, John realized he could build an optimized portfolio that hits his income goal in 19 years instead of nearly 70. And if he bumped that to $35 a day, to pull this off, you need to understand 3 specific asset classes, starting with the safest. They are called dividend aristocrats. These are not flashy, volatile tech startups. They are massive, boring, incredibly stable corporations inside the S&P 500 that have not just paid dividends, but actively increased their payouts every single year for at least 25 consecutive years. Through recessions, market crashes, and global crises, they kept raising the rent. Companies like PepsiCo, 3M, or Hormel. They typically offer a dividend yield around 3 to 4%. That might not sound life-changing, but compared to the broader market, it shifts the math dramatically. Suddenly, to hit your $40,000 a year goal, you no longer need $6 million. You need about $1 million. Still a massive number, but it is a number that disciplined investing and compound interest can actually reach in a reasonable time frame. The aristocrats give you stability. They are the anchor. But they are not the fastest route. If you want to move quicker, you have to look at real estate. But not the kind where you get a frantic phone call at 2 in the morning because a pipe burst. We are talking about real estate investment trusts, or REITs. These are companies that own and manage commercial real estate. Shopping malls, apartment buildings, self-storage facilities, like CubeSmart or National Storage. By law, these companies are required to pay out at least 90% of their taxable income to shareholders as dividends. Because of this legal requirement, the yields are significantly higher. Historically, US REITs have delivered strong returns, and you can easily find reliable ones yielding between 7 and 10%. Let us run the math on a 10% yield. To get your $40,000 a year, your required investment plummets to just $400,000. You just shaved over $500,000 off your target. Plus, unlike traditional stocks that pay out every 3 months, many REITs pay you every single month. It mirrors a real salary, which is a massive psychological advantage when you are trying to transition away from a 9-to-5 job. The catch? They are sensitive to economic downturns and interest rates. If the economy slows down and commercial tenants cannot pay rent, those high dividends can be cut. You trade some safety for speed. But what if you want the absolute fastest path possible? The shortcut. This brings us to a complex financial instrument made incredibly simple, known as covered call ETFs. This is where the yields start looking a little absurd. Funds with ticker symbols like QYLD or XYLD often boast yields between 11 and 15%. If you target a 13% yield, your required investment to live off dividends drops to roughly $300,000. That is the price of a small house in the suburbs to completely replace your working income. How is that even possible? These funds buy a basket of stocks, but then they use the options market to generate instant cash. They sell what are called call options on the stocks they own. They are essentially selling someone else the right to buy those stocks at a certain price. In exchange for granting that right, the fund collects a fee, called a premium. That premium is then handed directly to you as a massive dividend. You get the stock appreciation, plus the option income. It feels like a secret money tree. But here is the quiet, uncomfortable reality. This is where human greed often takes over. You might see funds tied to single highly volatile stocks, like Tesla, offering a theoretical 95% yield. It is easy to look at that and think you only need $40,000 invested to retire tomorrow. But that is a mirage. Covered call ETFs cap your upside. If the market skyrockets, you miss out on the biggest gains. And if the underlying stock collapses, your capital vanishes, and that massive dividend gets wiped out with it. High yield always hides high risk. So, what is the actionable framework? You do not dump your life savings into the highest yield you can find. That is how you lose everything. You build a machine. You use the safety and consistent dividend growth of the aristocrats to form your foundation. You mix in the monthly cash flow of real estate investment trusts to accelerate your income. And if you have a high risk tolerance, you carefully sprinkle in covered call ETFs to supercharge the overall yield. You reinvest every single penny until the machine produces enough cash to cover your life. The fastest way to live off dividends is not a lottery ticket. It is a mathematical equation combining a target yield, daily consistency, and time. You have to decide if you want to spend the next 40 years making someone else rich, or if you are willing to divert a fraction of your daily spending to buy your own freedom. The blueprint is right here. It is just waiting for you to execute it. Before we wrap up, I want you to ask yourself a very serious question. If your paycheck completely stopped tomorrow, exactly how many days could you survive on the money your money is making for you right now? Like, share, and subscribe for more videos.